Hey guys, in this video, I'm going to be explaining the red flags and why they are important. So we have a list of red flags over here: when to avoid trades, when price is near sessions, when price is near opening price, when price is near news price, when candle prior to entry is too large, and when price is ranging. So I'll go over these one by one and show you guys examples why we would avoid them. So looking over here at the sessions, you can see that the sessions are basically the previous session high lows. So if you turn on the sessions high-low indicator, it'll automatically plot on your chart over here. And you can see we have the London high, New York high, Asia low, and London low down here. Just by looking at these price points, you can see that price gets highly manipulated whenever price gets near it, right? So as you can see from up here, when price got near this London high, you can see how price kind of came near it, bounced off, came near it, bounced off, right? That doesn't always happen though. As you can see from this candle over here, price actually broke right past the New York high and Asia high and didn't even retrace at all. It just broke through, kind of bounced a little bit right here and dropped even further. So whenever you take trades at the sessions, this becomes an area of manipulation, and you're really taking a gamble here because you don't really know if price is going to bounce off it or if price is going to shoot right through it like it did here. So whenever you take trades around this point, you don't really know. It's like a 50% chance of you getting it right or getting it wrong. And at that point, it's not even worth the risk. So for that specific reason, we avoid trades whenever they're near the sessions. Same thing for opening price. As you can see right here, the blue line is opening price for New York session. I have it plotted right here. I manually plot this myself using the horizontal line tool. And as you can see over here, looking past, price has trouble getting past it, right? But when it finally does get past it, it blasts right through. So it's the same situation that we have with the sessions over here. It just becomes an area of manipulation, and you really have, you're gambling at that point. So it's better to just avoid trades and wait for the next one rather than taking one at that point and either hitting your TP right away or hitting your stop loss right away. So that's the reason for sessions and opening price. Thirdly, for the news price, it's the same exact thing. So looking over here at this pink line, I plotted news price here. And as you can see, price pretty much spikes directly off that price point, right? So price pretty much came back, it came down, shot up, spiked directly off of the news price and came down. So you could have been in a buy here, you could have been looking to enter a buy, and you would have been screwed if you took this trade here because price would have spiked all the way down. So you're really taking a gamble when you're taking trades at these price points, and it's better to just avoid them rather than taking that risk. You can see again right here, same situation. Price comes up, spikes the news price, shoots right back up. Same with right here. And same with right here. So that's a quick rundown as to why you should avoid these trades. The same situation happens with candles when they're too large. So let me see if I can find an example over here. I'll just use this one down here. It's not super large, but it's pretty big compared to the others. So as you can see, whenever you have a big candle like this, you typically want to avoid it. And you'll measure this candle compared to the other candles, right? So this candle right here is very large compared to this one, compared to this one, this one, this one, this one, etc. Whenever you have a big candle like this drop down, price tends to retrace back. And there's two different levels where price retraces to it. It retraces to the halfway of the candle, which would be right there, or the entire candle, setting up for possible reversal, right? So say, for example, you're entering a short position right here. Instead of entering it right away, I would just wait, because it's going to retrace to the halfway mark like it did right there, or the full candle before shooting right past it. If this happens and you really want to enter a trade, I would typically just wait, let it retrace, and then have your sell order just waiting below here, so that when price comes back to entry, it'll fill your order and you can get into the trade. However, if you enter right away and it's a big candle like that and it retraces, price can do the complete opposite and stop you out. So that's the reason why we avoid entries when the candle prior to entry is too large. Lastly, when price is ranging, this one's pretty obvious. As you can see right here, I'll just replay it again. Price was ranging here for a bit. You want to avoid trades when price is ranging like this, because there's a lot of uncertainty. Because when price starts to range like this, price can go either way, right? Price will either correct back down and continue dropping, or price can shoot up. So if you're taking a trade here, you're really taking a gamble, just like as you would with the other red flags, because price can go either direction. You can get lucky and price will shoot up, or you can get unlucky, price will shoot down. Vice versa, if you take a sell here, you can get lucky here, you can get unlucky, whether price shoots in your direction or not. So that's why we have these red flags here. It's better to just avoid them because you have to keep in mind that with trading, it's all about risk management. You have to avoid the bad trades and capitalize on the good trades. So that's it for this video here, and I'll see you guys in the next one.